you're paying more over time because you didn't put any money down. The more money you put down, the less interest you pay. So over the length of the loan, you got to pay a lot less if you put 20% down. All your money into the house is not always a great idea. It's better for you to have, bring less money, put less money into the house and have more money so that if something does happen to the house in terms of repairs, you have that money in the bank. So we're talking about down payment assistance programs today. A lot of people are unaware of it. And let's talk for a brief second about why you may be unaware of down payment assistance programs. These programs were invented to get first-time home buyers into homes. Or, even if you haven't owned a house, even if you haven't owned a house in the past, you may still qualify for these programs. The reason was people, as houses got more expensive, the down payment requirement, obviously in dollar amounts, got more and more expensive, right? And so the government was trying to figure out a way to make this more or easier, to make the home buying process easier in terms of how much money they need, how much money a home buyer needs. So the reason you may not have heard about this is really because most of the money for these down payment assistance programs come from the lender side. So the lender, me, myself, as a loan officer, as a mortgage broker, the actual lender behind your loan, we contribute most of that money to the down payment assistance program. So there is not much of an incentive for the industry to advertise these programs. And, the government gives some money to the program. But like I said, most of it comes from the banks. If you're talking to a loan officer out there, and a general retail loan officer, even a mortgage broker, most of them will not have heard about the program or know how to structure it. So you have to find people, if you want that money, you're going to need to find people who know about how to structure the program, how to structure the deal. And there's lots of ins and outs, and that's my trade craft. So I'm not going to talk about that today. But there's lots of ways to structure these deals so you bring even less money to the table.
Time out for a second.
Yes.
When you say deal, you are talking about the loan package for that future home owner.
Correct. Yes.
Got it. Okay.
How to structure that your mortgage loan in the right way to get it through the process.
Because your loan officer is your ambassador to the lender,
Yes,
who is writing the check.
Yes, who actually gives the money. Now, the loan officer may work for that lender. That's a mortgage banker
Or a big box lender.
or a big box bank, or they also happen to do mortgages. Those guys work for the bank. In my case, I work for myself. So
i.e. the future homeowner.
I end up working for you and not for the bank, and that's why I do this.
That is a fiduciary difference.
Yes.
I just wanted everyone to be aware of that.
So in my past, I was a mortgage banker working for a bank, and my legal duty was to do what's best in interest of the bank, not the client. So I flipped that around by becoming a mortgage broker, and now my fiduciary duty is to the borrower.
Important difference.
Difference in your way of thinking and attitude and so on. It does make a difference. And I knew that, having been a real estate agent in the past, I knew all about making sure that your thought process is in line with where it needs to be, which means you're representing your client, right? And your client is the buyer.
So you come alongside like the real estate professional and help carry the load, if you will, to the finish line, keys.
Right. So
part of the gears. Carry on.
A scenario that just happened last month. A young couple, imagine it might be you listening right now. It was a kindergarten teacher. She was a kindergarten teacher. He worked in restaurants. They had been to 3 different lenders to get pre-approved. They kept trying. I think, if I remember correctly, he's 27 and she's 25. So really young, and I applaud that, right?
Absolutely.
He has a family member who kept asking, why are you not buying a house? And, they kept trying, and lenders kept saying to them, you don't have enough money to buy a house. Your savings account, your checking balance is too low for you to buy a house. And they were being quoted, closing costs, $15,000 to $25,000 for a $350,000 house.
That seems a little high.
No, it's actually surprisingly pretty accurate, but the down payment and closing costs, it was just they were just told you don't have enough money. You got to save up more money. Their response to that was, this is going to take us years to save up that kind of money, right? And you may be in that same boat right now, or your bank balance is not high enough where you feel like buying a house is out of reach for at least 2 years, 3 years, 4 years. And that's how they felt. So this family member said, well, if somebody can figure it out, talk to Mark, because she had used me on a previous transaction to figure out her situation. And so she knew me, she referred me to them. They came to me, they said, we don't have, we don't hold up much hope that we're going to be able to buy a house, but we would love to buy a house. And I said, let's look at it. We looked at their finances, we looked at everything, and we ended up, they qualified based on their income for a $350,000 house with a 3% down payment, which, by the way, a lot of you are mistaken because you could told it has to be a 20% down payment. It's not. You can do as little as 3% down. If you're, well, we'll get to the second story in a minute. We can even do no money down. This couple, I said to them, look, your monthly payment on a $350,000 house at 3% down, it's probably going to be about $2,800 a month. Is that comfortable? They said, that's fine, right? And they said, but it really doesn't matter. We don't have $20,000, right? So I said, well, what if we instead had you bring $3,000 to the table? Would that work? And they said, absolutely. They had about $9,000 or $10,000 in the bank. So they said, sure, but we don't believe that that's actually possible. And I said, well, let's figure this out. Let's do it. And so I got lenders involved. We figured it out. The disclosure, when they went under contract, the initial estimate was that they needed $2,700, $2,800.
Time out on that thought. Let's define disclosure, because you're using nomenclature slang, lender slang there. So what he's talking about is the closing disclosure, which is a federal mandated form that discloses to you, the buyer consumer, what the expected monies that are going to be required to close on the house. Close defined as securing keys to your new home.
Actually,
there you go.
So this
carry on.
The disclosure actually goes line by line into all the expenses that happen during the transaction of the house, during the purchase. So the initial estimate was they would need about $2,800, which was under what I had said. And so they were super happy. Come to find out that, they had actually secured extra money from a family member just in case. So we then, fast forward, we had closer to closing. Obviously, they're very nervous because they're first-time home buyers. They're waiting for the shoe to drop. They're waiting for something to happen that was bad, right? And so the final disclosure comes to them. And in the end, it's that $350,000 house, they needed $988 to get in the door. So that was all they brought to the closing table. So $988, where everybody else was telling them $15,000 to $25,000.
Less than $1,000, and they have keys.
And they had a $350,000 house. So it's doable. It's possible. You do have to fit into some boxes.
So Mark, let's talk about that, how to move forward with this great insight that you've shared with everybody, which is you don't have to be a millionaire to buy a house, right?
You have to have $20,000.
Right. So what are the three key, seminal questions to help people get from aha, which is right now, we hope, to coaching their lender of choice to help them find that money?
You can coach them, but what I would suggest that you do is, the lender that you do talk to, ask them if they are aware or deal in down payment assistance programs.
All right.
If they have done them.
So what's their experience?
They have experience, because you do need experience to structure them. And so you want somebody who's been doing it. So ask them that. If the answer is no, then you may need to find other professionals and ask around. Your real estate agent could be somebody who knows a lender or a loan officer that specializes in down payment assistance programs or has experience with it enough to be of value to you and your transaction. So that would be the way out.
And then maybe a third wrap-up question would be,
I don't know that there's a third question. It's really just being knowing that the programs are out there, knowing which programs are out there, which fit your specific needs,
Fair enough.
because that's something that has to be, figured out. Sometimes these programs are actually great for people with bad credit. So if you are a first-time home buyer that's hung up on not just not having enough money in the bank, but also not having great credit, these programs can help you a lot of times get into the house, even when your credit isn't so great. Fun little side note fact: if you're a home buyer that does not need the grant money, meaning you have enough money in the bank for down payment and closing costs, but your credit isn't that great, guess what? Grant programs a lot of times have a better interest rate than the market rate would be for your specific scenario, and your credit score, the overall market rate would be higher than the down payment assistance program.
So Mark, let's talk about bad credit. Please define what is a non-home buyer ready credit score
Really,
from a lender perspective.
Really, there are programs that can get you into the house at a 580 score, but I personally, they rarely work. Actually,
if you're at 600 or under,
I would say 620 or under
620
is not ready. Now, some people will say that you're ready and you may get through the process, but in the meantime, you spend a lot of money on inspections, on appraisals, only to find out that at the end, you don't get approved, right? So if you're going to spend time shopping for a house, give yourself the best shot. And that means getting to 620 or above, okay? 620 to 650 is kind of the beginning range where you can get a loan. And then 650 and up is where the rates get better. But don't wait on the rates on your score to get better, because in the meantime, the house is getting more expensive.
That is true.
So if it takes
Very
a
true.
year to get to 700 credit score, in the meantime, you've lost $15,000, $20,000 on that $300,000 house. You've lost that money because it's gone up in price, not to mention your house payment will be higher because now the house is 320 instead of 300. So if you have a 640 credit score, 620 credit score, talk to your lender, see what can be done.
I love it. What a great summary.
So another story on less money in the bank than you thought you needed, or I didn't say that right. Another story about
workaround, a move forward workaround.
Yeah, workaround if you feel like you don't have enough cash at the bank to buy a house. If that's you, listen to this story. So this couple both made great money, had some money saved up. They were doing fine. They could have bought a house just on their own with no assistance programs necessary. I found out early in the conversation that he's a veteran. So I brought up immediately that he could do no money down on a veteran is allowed on a VA loan, is allowed to do no money down. So I don't recommend doing that, because what happens is your house, you're upside down. So the amount of money that you spend for closing is added to the sales price. And so your starting point of, your $320,000 house is really, you spend $340,000. So it's going to take you a year or two to get that extra $20,000 in appreciation.
So in regular people speak, what he's saying is what your mother has always told you, and that is nothing in life is free. Even the courtesy and a thank you from the U.S. government of serving our country is not completely free. Because veteran loans, if I remember, you can finance up to what is it, 103% of the purchase price?
And higher. I rarely bring that up, because that puts you even further behind on the.
But at the minimum, so what you're saying, and if I'm hearing from a consumer, just layman's terms, you're saying that instead of bringing that cash out of your savings account for down payment, that down payment amount, let's call it 3%, is instead loaded into the contract price. So you're actually borrowing contract price, purchase price for the house, plus the down payment value?
No, the sales price is sales price. Okay. So the lender is just giving you 100% of that. That's it, instead of 97%.
Oh, I gotcha. So instead of putting into the mortgage 97% of the purchase price, you're putting into the mortgage 100% and amortizing that over 30 years.
Right. So you're paying more over time because you didn't put any money down. The more money you put down, the less interest you pay. So over the length of the loan, you got to pay a lot less if you put 20% down, right? But it also means you tie up the cash in the house.
Right. Right.
And so this veteran, for example, he was more interested in doing things to the house. He wanted to have his cash, not just, he was a first time home buyer, so he was nervous about the whole thing anyway. And I said to him, maybe it's better for you to have, bring less money, put less money into the house and have more money so that if something does happen to the house in terms of repairs, you have that money in the bank.
So keeping cash liquid, keeping
Right.
cash accessible versus dumping it all into the house on the front end.
Put it into a savings account that you don't touch.
You mean I can't put into a savings account that's marked as pool?
Yes.
Okay.
Or vacation or
Right.
I said to him, now make sure that you spend that money on the house, right? Because it's supposed to be in the house. You're supposed to have put it into the house in form of the down payment, but you didn't do that. So don't go spending that money on whatever. Spend it on the house. So it works if you're disciplined about it. And the reason I bring that up is a lot of my higher net worth clients actually put less money down than they think. A lot of them are actually putting 5% down on, $700,000 houses. Why do they do that? They do that because they want to conserve their cash.
Yes.
Because they want to upgrade the house. They want to reinvest into the house, that cash. They know they're only going to live there 5 years, 7 years. So they're doing the math in their head saying, that extra 10% or 15%, if you go from 5% to 20%, that's 15% difference. That 15% is a lot of money. That money can also work for me.
In the market, if the market is running at 8% or 11% gains,
Right.
depending on your guidance.
There are lots of reasons why putting all your money into the house is not always a great idea. The house is earning you 5% a year, right? So let's just average that out. 5% a year is not a bad return, but if you have other opportunities and you're disciplined with your money, that's the key. Some people do this and they're not disciplined, and it all ends up in a bad place because they didn't make extra money with that money they didn't put in the house. Instead, they spent it all. And so you end up with a bad scenario.
Yeah. Don't feel guilty about asking for money when it comes to buying a house because you're actually pulling a card, an ace out of the deck that a 1%er does.
So, to tie things together here, down payment assistance programs work on many different levels to your benefit on many different levels. You got to think more like a high net worth person does. A high net worth person says, I can use my cash to put into the house, or I can use my cash to make more money.
So they're strategic with their spend.
Right. And think about this. When you're high net worth people become high net worth people by using other people's money.
Yes.
And so your down payment assistance programs, you're using other people's money to build your own wealth. And that's the best scenario there is because it's really at no risk to you. Now, if you sell your house within a certain time frame with these down payment assistance programs, you will have to pay them back. So that's the only hiccup on this, that you have to live in the house 3 to 5 years.
I was going to say 3 to 5 years.
So you're going to probably live there 3 to 5 years anyway. So other people's money, using other people's money is a really strategic move that most high net worth people do all day long, every day. They leverage the money. And so use the money available. And even if you're not a first-time home buyer, you can leverage mortgage programs to your benefit. You can leverage programs. There's lenders that offer assistance that I'm not assistant, but incentives. Any given day, I have 100 different banks I look at, and any given day, there's 2 or 3 of them that will offer incentives, meaning they will give you cash at closing, cover some of your closing costs if you choose them as their lender. They want your business. So why not use that money? It's not costing you anything, but it's available for you to take. And many people don't do it. They just go to the first person. They go to some online bank and fill out an application and think that's it. But they haven't really looked around. They don't know what's out.
There you go. Yes. So the key takeaway is you want some free money. The easiest way to free money is to start educating yourself and knocking on doors and finding out about the possibilities. Don't assume.
Right.
We all know what the assume means, right? Don't assume, and be intentional and strategic about your next steps on what that roof looks like over your head. it can happen.
So if you have questions, because everybody has a different scenario, right? So if you need answers, they're going to be very specialized to your needs and your wants and your situation. So come reach out to us if you have further questions about down payment assistance programs. We're happy to help you. Bess in her real estate capacity can help you on a lot of different fronts on that too.
Absolutely. Yes. I mean, let's coffee chat. Reach out and we can make a coffee date and we can talk about a curated process that meets you and your needs on how to get from what are the gears from today to your keys. Thanks for joining us today on Keys and Gears.